Donald Trump has told a rally at a US steel plant in Pennsylvania that he intends to double US steel import tariffs to 50%. The president said the increase would offer the country's steel industry more security.
On Monday, New Delhi proposed retaliatory duties on certain US-made products shipped to India. This was a response to Washington's tariffs on Indian steel and aluminium products.
In a stunning announcement that sent shockwaves through industries and global markets, President Donald Trump has declared a 50% tariff on all steel and aluminum imports into the United States. Speaking from the U.S. steel plant in West Mifflin, Pittsburgh, Pennsylvania, Trump said the new tariffs, which double the 25% rate imposed during his first term, will take effect starting June 4th. Trump framed the decision as a bold step to protect American workers and revive U.S. manufacturing. "We're raising tariffs on steel imports to 50% to further secure our steel industry," he told a cheering crowd. The announcement was linked to a $14.9 billion deal with Japan's Nippon Steel to help expand U.S. steel operations. Trump promised the move would save American jobs and bring steel production back to American soil. But while the announcement brought cheers from steel workers and certain political supporters, it sparked immediate concern from manufacturers, trade partners, and economists. The U.S. is currently the largest steel importer in the world, excluding the European Union, bringing in a massive 26.2 million tons of steel in 2024, according to the Department of Commerce. Industries that rely on imported steel, from automakers to home builders to food packaging companies, are now bracing for higher costs and tighter supplies. Goldman Sachs analyst Ian Dinsmore warned that the tariffs would hit demand. Higher prices are also likely to weigh further on U.S. steel demand from the manufacturing sector, which we already expect to contract this year. The impact on the stock market was swift. While the S&P 500 closed the day up 0.4% and the Nasdaq gained 0.7%, it was not without turbulence. U.S. steel giants Nucor and Steel Dynamics surged in double digits, celebrating the protective policy that will boost their business. But it came at a cost. Detroit automakers Ford and GM both saw their stocks fall around 4%, hit hard by concerns that higher steel prices will drive up manufacturing costs. Trump's additional comments urging automakers to move all production back to the U.S. only added to their worries. Automakers now face a difficult choice: absorb the higher costs or pass them on to consumers, potentially driving up car prices. Meanwhile, consumers are likely to feel the pinch beyond the car lot. Steel is everywhere. It's in washing machines, refrigerators, canned food packaging, bridges, skyscrapers, and even medical equipment. As steel prices rise, so will the cost of many everyday items. For the average American household already stretched thin by inflation, this could mean paying more for essentials. A can of soup, a new appliance, even home repairs, all could become more expensive, and the fallout doesn't stop at America's borders. India, which exported $4.56 billion worth of steel and aluminum to the U.S. last year, called the tariff hike unfortunate, warning that its exporters stand to lose big. Australia, too, expressed dismay. The country's trade minister said it was not the act of a friend, signaling that diplomatic relations may sour. The European Union quickly condemned the decision. The European Commission warned that the move would cause greater uncertainty in the global economy and hurt businesses and consumers alike. Officials hinted at the possibility of retaliatory tariffs, and while the EU had earlier paused its own steel tariffs to allow negotiations, that goodwill may now vanish. Some experts now fear a global trade war could erupt, echoing the economic tension seen during Trump's first term. The difference this time? The stakes are higher, and the economy is more fragile. The ripple effects are already hitting markets beyond steel. On the same day, aluminum prices on the U.S. physical market jumped 54%, and U.S. hot-rolled coil steel rose 7.4%. These are significant jumps that show just how fast costs are climbing. Small and mid-sized manufacturing companies, which don't have the financial cushion of the big players, are in a precarious position. Many operate on thin profit margins and cannot afford the sudden rise in raw material prices. Companies like Leggett & Platt, a Missouri-based furniture and bedding manufacturer, may have to cut staff or reduce production. Other businesses, like local appliance makers or regional car part suppliers, say they are already receiving warnings from vendors that prices will increase. For many of these companies, the next few months could mean layoffs, cutbacks, or even closures. Analysts say that in the run-up to June 4th, a rush to stockpile steel could overwhelm ports and supply chains. Already, logistics firms are reporting increased inquiries, and warehouses are bracing for a flood of incoming shipments. The legal landscape is also murky. A recent U.S. appeals court decision upheld Trump's earlier tariffs, overturning a lower court ruling. While it's a short-term legal win for the administration, some judges indicated that specific tariffs might still be legally questionable. That means ongoing court battles could change the rules again in the months to come. And then there's the Nippon Steel deal. The Japanese company's plan to acquire a majority stake in U.S. Steel has already drawn criticism from unions like the United Steelworkers, who fear that foreign control may ultimately hurt American workers. While Trump says the U.S. will retain a partial ownership stake, the lack of clarity has raised questions about who will really benefit from this deal. Outside of the steel headlines, markets saw major shakeups. Meta, formerly Facebook, surged on news that it plans to launch a powerful AI tool for creating ad campaigns, which shook up the advertising world. Stocks of ad agencies like Omnicom, Interpublic, and WPP all dipped over 2%, signaling concerns that AI could start replacing traditional creative jobs. DraftKings and Flutter Entertainment, the parent company of FanDuel, also saw sharp declines. Illinois quietly passed a new budget over the weekend, which includes steep new fees for high-volume sportsbook operators. DraftKings dropped 6% and Flutter slipped nearly 3% as investors reacted to the surprise move. But not all the news was bad. Applied Digital soared 48% after announcing a pair of 15-year deals to support CoreWeave's growing AI infrastructure. CoreWeave itself jumped 8% on the news. Meanwhile, Tempus AI rebounded 15% after a brutal drop last week, proving just how volatile tech stocks remain in an AI-driven economy. Energy stocks also rose, despite a production increase from OPEC+. Oil prices remained relatively stable, but investor optimism in the sector helped boost the S&P 500's gains. Still, the broader economic picture is one of unease. While the S&P 500 and NASDAQ ended the day in the green, the fact that more stocks declined than rose suggests undercurrents of fear. Investors are clearly nervous about how tariffs, inflation, global tensions, and new technologies will reshape the economy. Everyday Americans have reason to worry. Jobs may be saved in one industry, but lost in another. Prices may go up before wages do, and as global allies grow frustrated, the risk of economic retaliation rises. This isn't just about steel. It's about the future of American industry, trade, and the lives of millions of working families. Will the tariffs deliver the manufacturing renaissance Trump promises, or will they create a new wave of uncertainty, layoffs, and higher living costs? While the domestic response to Trump's 50% steel tariff has dominated headlines, one overlooked consequence lies in the potential disruption of federally funded infrastructure projects across the United States. Many of these projects, including bridges, railways, highways, and public transit systems, are partially dependent on competitively priced steel to remain on schedule and within budget. With steel prices now surging, state and local governments could face significant cost overruns, forcing them to delay, scale back, or even cancel critical infrastructure developments. In places like the Midwest and Rust Belt, where these projects are both politically sensitive and economically vital, such delays could erode public trust and strain coordination between federal and local agencies. There is also growing concern among civil engineers and procurement officers that the ripple effects could spread to bidding processes, where fewer contractors may be willing to take on high-risk, fixed-price projects amid material price volatility. Ironically, while the tariffs are promoted as a tool to strengthen domestic industry, they may undercut national efforts to modernize infrastructure, creating tension between Trump's industrial policy and the bipartisan goals of the Infrastructure Investment and Jobs Act. This policy clash could become a flashpoint in the months ahead, especially if inflationary pressures force Congress to revisit infrastructure funding terms.